$27,000 a year. Break that into a daily number, and you're paying roughly $74 every single day just to remain insured, sick or not, doctor visit or not, ambulance or not. That's the quiet, unglamorous math sitting underneath the average American family's health coverage right now, and almost nobody actually sits down and does the division. Here's the reframe, and it's worth saying plainly, once at the top. Health insurance was sold to you as protection against disaster. But the way the arithmetic actually behaves, it functions less like protection and more like a toll booth you're required to pass through just to be allowed inside the healthcare system at all. And the toll rises every year whether you pass through it once or 100 times. Let's start with the plan most people think is the good one, employer-sponsored coverage. The average total cost of a family health plan through an employer right now runs around $25,600 a year. Your employer typically covers about 75% of that, somewhere near $19,300. You, the employee, quietly cover the rest, about $6,300, usually sliced out of your paycheck in small enough pieces that it never quite registers as one giant number. But here's the twist most people miss completely. That $19,300 your employer is generously covering isn't a gift, it's money that could have been paid to you directly, as salary. Companies build total compensation budgets, and health coverage is simply one line item competing with wages for the same pool of money. So if your employer instead handed you that $19,300 as cash, here's what would actually happen to it. First, payroll taxes take a bite, about 7.5%, dropping it to roughly $17,800. Then ordinary income tax, at a typical effective rate near 22% for a middle-income household, trims it down again, landing you around $13,900 in your pocket. Compare that to the $19,300 of coverage you're technically getting instead. That gap, roughly $5,400, is essentially the tax-sheltered discount the system gives you for taking your compensation as insurance instead of income. It's real value, but it's also proof that the number on your pay stub was never the full price. The full price was always closer to that $27,000 figure, just split into a visible piece and an invisible piece. Now flip the scenario. Not everyone has an employer absorbing 3/4 of the bill. If you're self-employed or your job doesn't offer coverage, you're buying on the individual marketplace, and there the math gets a lot less forgiving. The average marketplace family plan runs close to $2,000 a month, call it $23,900 a year, and unless your income qualifies you for a subsidy, that entire number comes straight out of money you've already paid income tax on. No employer buffer. No 75% someone else quietly covers, just the full sticker price, month after month, indefinitely. And this is where the story splits into two very different Americas. One where a stable employer job effectively hides 2/3 of your true healthcare cost inside a benefits package you never see itemized. And one where the exact same coverage, for the exact same family, costs nearly as much as a car payment on a brand new SUV every single month, forever, with no ownership at the end of it. Now here's the part that rarely gets said out loud. The $27,000 figure isn't even the ceiling, it's closer to the floor. That number typically reflects premiums plus average expected out-of-pocket costs in a normal year, no major surgery, no hospital stay, no chronic diagnosis. The moment you add a deductible into the mix, the real annual exposure climbs fast. The average family deductible right now sits around $3,700, and that's before a single copay for a specialist visit, a round of physical therapy, or a prescription that isn't on the preferred list. Once you're past the deductible, most plans still make you share costs up to an out-of-pocket maximum. For a family plan, that ceiling is commonly set around $18,000 in a single year. Stack a bad year on top of the base premium, and a family isn't looking at $27,000. They're looking at something closer to $35,000 or even $40,000, and that's still technically in-network, still technically covered. Let's follow the money one layer deeper, because premiums and deductibles still aren't the whole picture. There's a category of spending that barely gets discussed, the cost of things insurance touches but doesn't fully absorb. Mental health counseling, for instance, often gets a copay of $30 to $50 per session, and if a family member is seeing a therapist weekly, that alone adds up to somewhere between $1,500 and $2,600 a year, sitting quietly outside the headline premium number. Physical therapy after an injury commonly runs 8 to 12 visits, at $40 to $60 a visit even with coverage, another few $100s nobody budgeted for. None of this shows up when someone quotes you the average annual cost of health insurance. It shows up later in a checking account that doesn't quite make sense at the end of the month. Now, to be fair to the system for a moment, because this video isn't trying to make anyone panic, this $27,000 reality does not land the same way on every household, and it's worth being honest about who it actually describes. A healthy single adult in their 20s on a catastrophic or bronze tier plan might pay closer to $3,000 or $4,000 a year total because they're simply not consuming much care, and their premium reflects that. Families who qualify for Medicaid based on income pay close to nothing in premiums, with the state picking up the true cost instead. And once someone reaches Medicare eligibility, the math resets entirely. A retiree on Medicare, even with a supplemental plan, is often paying somewhere in the range of $2,000 to $3,000 a year out of pocket, a fraction of the working-age family number, because the program is structured completely differently and heavily subsidized by decades of payroll tax contributions already made. So this isn't a story about every American drowning under a $27,000 bill. It's a story about a very specific, very large group, working-age families, particularly those who are self-employed or whose employer coverage is thin, sitting in the most expensive years of their healthcare life at exactly the same time they're raising kids, paying off cars, and trying to save for retirement. Which raises an obvious question: where does all this money actually go? It's not disappearing into thin air. Roughly 80 to 85 cents of every premium dollar is required by law to go toward actual medical claims and quality improvement. That's the medical loss ratio rule insurers have to follow. The remaining 15 to 20 cents covers administration, marketing, executive compensation, and profit margins. On a $27,000 bill, that means somewhere between $4,000 and $5,400 a year per family is essentially the operating cost and profit layer of the industry itself. Not a doctor, not a nurse, not a hospital bed, just the machinery of the system running in the background. Now here's where the annual number stops being the interesting part, because the real story is what happens when you stretch this across time instead of looking at a single year. Take that $27,000 figure and hold it steady, which it never actually does, since healthcare costs tend to climb faster than general inflation, usually somewhere between 5 and 8% a year. But even holding it flat for a moment, across a 40-year working life, you're looking at over $1,080,000 moving through a household purely to maintain access to a doctor's office. Now let it actually grow at even a modest 6% annually, compounding the way premiums genuinely do. And that lifetime number climbs well past $4 million by the time someone reaches Medicare age. Nobody ever sees that number in one sitting because it arrives in small monthly installments instead of a single invoice. But the money is just as real, and it moves through a household's finances with the same weight as a second, permanent housing payment that never gets paid off and never builds a shred of equity. And that comparison is worth sitting with for a second because it explains why this cost feels so different from other big expenses. A mortgage payment, however large, is buying you an asset. A car payment, however painful, ends eventually and leaves you with a vehicle. But a health insurance premium is structurally different. It resets to zero value the moment the coverage period ends. You can pay flawlessly for 20 straight years, never miss a payment, never file a major claim, and at the end of it, you own exactly nothing more than you did on day one. The only thing you've purchased is the right to keep purchasing it again next month. Let's zoom into the regional layer for a second too, because $27,000 isn't a flat national truth. It shifts depending on where you live, sometimes dramatically. Family premiums in a state like West Virginia can run several $1,000s higher per year than the national average, largely because of a smaller, older, less competitive insurance market. Meanwhile, a state like Utah, with a younger population and more competition among carriers, often sees family premiums sitting a few $1,000s below the national number. So the exact same job, the exact same income, the exact same family size can carry a genuinely different price tag on healthcare access depending purely on geography, which means two households earning identical salaries in different states are not actually living with identical financial pictures, even though their pay stubs look the same. Now let's talk about the moment this all becomes suddenly, uncomfortably visible: losing a job. While employed, that 75% employer contribution is invisible, folded quietly into the background of your paycheck. The instant employment ends, that invisible 75% doesn't disappear, it transfers directly onto your shoulders. Continuing the exact same employer plan independently commonly runs somewhere around $2,100 a month for a family, which is over $25,000 a year, paid entirely out of pocket, usually right at the exact moment income has stopped or dropped. It's the same coverage, the same doctors, the same card in your wallet, just suddenly billed at full, undiscounted price, which is really the closest thing to seeing the true cost of the system, with the curtain pulled back. There's one more layer worth adding, because it changes how you should think about that $27,000 number going forward rather than just today. Healthcare spending as a share of the average household budget has been quietly climbing for 2 decades, even as other categories like clothing and electronics have gotten relatively cheaper. That means health coverage isn't just an expensive line item sitting still. It's one of the very few costs in a household budget that reliably grows faster than income itself for a meaningful chunk of the population. Wages might rise 3% in a good year. Premiums, historically, tend to rise anywhere from 5 to 9% depending on the year and the state. Do that math over just 5 years, and a $27,000 bill can realistically become closer to $35,000 without a single change in the coverage itself. Same plan, same deductible, same network, just 5 years later. So where does that leave the average family trying to plan around this? Not panicked and not powerless, just working with a clearer picture than the one usually presented. The $27,000 number isn't a scare headline. It's simply what it costs right now in this country to maintain access to modern medical care for a family of 4, spread across premiums, deductibles, copays, and the slow annual creep that comes built into the system. Some households pay it mostly invisibly through an employer plan that hides 2/3 of the true price. Others pay it in full, out loud, every single month, with nothing hidden at all. But the underlying arithmetic, the toll booth, the annual reset, the zero equity is the same for almost everyone standing inside this system, just distributed differently depending on your job, your state, and your age. If this kind of number-first breakdown is useful to you, that's exactly what this channel does every week, taking a big, intimidating dollar figure and walking through the real arithmetic behind it until it stops feeling abstract. Subscribe if you want the next one in your feed, and tap like if this helped you actually see your own coverage differently, because the more people who understand this math ahead of time, the fewer people get blindsided by it